Welcome to the Commercial Real Estate Investing from A to Z podcast. I'm your host, Steph Bodrini. This podcast is for everyone who wants to learn about commercial property investing and be part of our real estate family. We get the best people in the industry to give you straightforward and practical advice that you can actually use in your investing. In today's episode, we are talking about how to deal with major problems that you will inevitably go through while investing in real estate. For example, closing on a property on the day that the president announces a national emergency. We are talking to our friend Loe Hornbuckle. He is the CEO and founder of Sage Oak Assisted Living and Memory Care. He is also the co-founder of Goodhorn Capital, a private equity firm focused on recession-resistant assets like boutique assisted living and build-to-rent developments. Here we go. So today I want to go over, things that every single real estate investor is going through on a daily, weekly, monthly basis, but people don't talk about. And these are problems that show up that we need to overcome that were not part of the plan. We all have had hard days, and I was crying the other day for buying a particular asset class. And today I invited my friend Loe. He posted something on Facebook the other day about a significant problem that him and his partners had to overcome over the last several months. And I thought it would be a great idea to share that with everybody. So when you are dealing with something, you can start thinking outside of the box and figure out how to solve the problem. With that, Loe, if you don't mind telling us a little bit about you, please.
Yeah, sure. So I live in Dallas, and myself and some others in our group are involved in, really kind of two primary asset classes. We focus on sort of boutique assisted living and memory care. We build and develop those. And of course, we also do build to rent projects. So we develop townhouses, duplexes that we, rent out and then sort of manage like any traditional multifamily. Personally, I have a few hobbies. I play poker and I'm into long range shooting. So there's a little quick synopsis of me personally and professionally.
Let's dive right into what was your project about and what were the initial goals, your timelines, and then your fundraising target.
Sure. So, basically, in regards to the post and kind of some things that you had mentioned and kind of our behind the scenes conversation, I find sometimes that, and I'm sure you probably notice this too, that, sometimes social media can be just, like a highlight reel, like nobody really talks about the stuff they deal with, or they never really do so in kind of an authentic way. And I've always just tried to just be myself. And, obviously I thought there was some interesting lessons from this particular project. So the first thing is that we had an opportunity to develop a 89 unit townhouse project that was going to be a build to rent project. So we were going to, build these, and we're going to do so in phases. Obviously 89 is not divisible, but basically we're going to do 30 units per phase in 3 phases. And the thing that we were kind of first considering is, should we self-fund this or should we, put this out to investors? Then kind of the next thing that kind of happened is, as we were in the process of wrapping up the deal, we started to notice that we were kind of struggling with people backing out of pledge commitments in a way that has never happened before. So to kind of set the stage in terms of timeline, this was happening in late January to sort of middle part of February. And so this was kind of the time when America was kind of waking up to COVID and what's that going to mean and what's going to happen. To compound matters, this was an opportunity zone deal. So a significant portion of our investors were opting to defer capital gains from things like the stock market. And of course, the week that we went to close the deal was the famous worst week in the history of the stock market, where it dropped like 20% in a couple of days. So that was kind of the backdrop. So like the world is chaotic. We don't know what's going to be happening, and we're in the middle of trying to trying to close this transaction. So the total equity raise was about $3 million. The total project was about 18 million. Because we were doing the construction and phasing, we had pretty favorable terms from the lender, having had a track record with that lender. And it was also an extension of an existing project. So we had a 60 unit project next door. We bought the adjacent land. So from the bank's perspective, we'd already successfully done a deal with them before. It was really just an extension of our natural business. So we really got very favorable terms from a great local lender. So that's kind of the backdrop of the deal and the situation.
That sounds like an incredible project. And then COVID hit. So this can be something that it can happen at any point in time in different types of versions, right? It can be the economy or anything else. So this one was COVID. How did you guys overcome this problem?
Yeah, it's a great question. I don't think I'll ever forget this, because how many people can claim that they closed a major real estate transaction on the day the president of the United States put the United States in a state of national emergency? So literally the day we were closing on the deal, the president's on TV saying we're entering a state of national emergency. And I guess, like a lot of people, like you're in California, right? Like, you have earthquakes, you have fires, there's all kinds of like city and state emergencies you see, but I've never seen a national emergency before. So I didn't know what that meant or what was going on. But all I know is I closed a very large real estate transaction, by some standards, 18 million, pretty large, on the day the president's on TV basically saying, the sky's falling. So that was very fun. I think the thing to understand is that, first off, because our construction was being done in phasing, we went ahead and sort of figured out what our three targets were, or really what we needed at a minimum to close the deal in terms of investor equity. Then the second question was, what do we need to do phases 1 and 2? And the next question was, what do we need to do all three phases? So we kind of broke the project up into a few different metrics. And so when we did this with our attorney, when you're doing a raise, people always focus on the ceiling, how much money you're going to raise. But the question that we asked ourselves was, what's the minimum amount of money that we can raise in order to not have the project be delayed? And so we came up with those three numbers. And, coming off a successful raise for the assisted living project next door, we kind of thought it was going to be very simple. We just closed another project that was a bigger raise about a month earlier. But obviously the world changed a lot in those 30 days, or those 45 days. And we started to notice that even though we had the deal fully pledged, that about 30% of the people that had pledged, pulled out for various reasons. Whether it be, fear of the unknown, whether it be like, hey, like I was going to put my stock market gains into the deal, I no longer have stock market gains, those types of things. So there's a lot of different reasons, but we were just noticing a tremendous amount of attrition. And I think the element that really kind of probably became interesting to you, and I don't want to speak for you or anybody else that sort of resonated with the idea, was whenever you're having a project that isn't being as successful as you wanted to, you get all these pledges and they back out. You have a couple of choices. And, one of those choices for some people is, okay, we'll just go out there and sell, right? Go out there and just sell the project, call everybody, do this, do that. And there's a lot of people that sort of think that's the correct strategy. And I don't particularly think that was the correct strategy on this deal. There's certainly a time in my life when I would have done that, and I don't begrudge anybody that does. But the second alternative for us was, this is maybe the worst time to be closing a deal imaginable, right? Like, it's potentially the worst time imaginable to be closing a deal.
Ever.
So, yes, in our lifetimes anyway. So we just said, listen, why don't we just how much money have we raised? And then, is that enough to hit our floor? And fortunately for us, it was not only was it enough to hit our floor, but we also could do the second phase of the construction as well. It's going to be very tight, but we were right there. So we said, look, we're about $1 million short, call it $1 million. Maybe it was 1.2 or something. I don't know, but let's just call it $1 million. So our philosophy turned into, what, instead of being hunters, instead of going out and trying to figure out a way to sell this thing, why don't we just pull it off the table? If somebody asks about it, we'll discuss it with them, but we're not going to discuss it as though we're actively raising money. If someone asks us if we're actively raising money, our answer is, hey, not really. And we decided to do that because we figured there's going to be better days. There's going to be days coming along where, someone will be interested in the project. Additionally, since we can do the first couple of phases without raising additional money, the timeline meant that we didn't really need the additional money for like a year, like maybe 2 years. And so
Mm,
we weren't really necessarily in a hurry. So I think the first thing that I think we were happy that we did was we were smart to set a floor. Sometimes when people are doing their operating agreements, they don't ask those questions. They just assume the raise is going to be successful. And so they don't set a floor. So for example, if you're doing a $3 million raise and you can close the deal with 2.8, well, then as long as you get 2.8, you can close the deal. In our case, that number was like, let's just say 2 million or 1.7 or whatever the case was. So that was the first thing that I think we kind of helped ourselves out with. We didn't know this was going to happen, but thinking through that things can happen and putting that in the operating agreement to the investor certainly was to our benefit. And then the second thing was being patient. Having the ability to say, you know what, there are going to be better days ahead, and look, there arguably have been darker days ahead too. But I think a lot of the fear in the investment community, obviously the stock market, whether you think it should be worth what it's worth now, has certainly stabilized and hit new all-time highs. And so, trying to invest in an opportunity zone deal at the worst possible time for the market was really just a timing issue. And so because we thought the project wasn't flawed, we didn't think anything had changed with the project, we thought the project was going to show very good resilience through COVID, we ultimately decided to be patient, kind of pull back on the deal. And then, of course, what kind of caused this conversation with you and I is that, we basically shared the story of how we completed the raise, but over a long period of time. So a raise that normally might take a week for us actually took 9 months because we weren't selling it, we weren't pitching it, we were just simply waiting for people to contact us or waiting for people to ask questions like, hey, what do you have? I'm looking for an opportunity zone deal. And that enabled us to be patient and to basically help people that had a need, as opposed to focus on ourselves, focus on what we need. Then, of course, it becomes a lot harder. And the other element for us was everybody that's ever raised capital over a long period of time will tell you that deals get stale. So
mhm.
sometimes a deal feeling like it's stale is just as bad as it being a bad deal, because people start to ask themselves, like, why have you been raising money for this so long? What's wrong with the deal? And so they just start asking these questions. It's only natural, right? We kind of joke all the time. I think we're both, middle aged and single. So like, people are like, what's wrong with you? Why aren't you married? I was like, well, hey, hold on, give me some time. So we gave our deal a little room to breathe, right, and a little opportunity to kind of find its legs, and that was really important, as opposed to, constantly once a week, once a month, putting the deal out there, putting the deal out there, putting the deal out there. Because sooner or later, people are going to ask, like, hey, why do you think you can't complete the raise? What's wrong with the transaction? And what that would have done is that would have caused the focus to be on the deal itself, on the transaction, as opposed to the circumstances of the timing, which we really identified as the key problem. And so we gave the deal opportunity to breathe and gave the deal opportunity to basically, and not only that, but get further along, right? Because if you're investing in a deal and we've already, started putting in roads, then, or we've already started doing certain elements of construction, then you are investing at a sort of a de-risked point in the deal because things have happened and you're getting treated from an investment point of view exactly the same as if nothing has happened, which is to the investor's advantage.
And now, in hindsight, all of this makes sense. But during, end of February, early March, was the answer obvious to you guys? Were you freaked out? Did you cry a little? What were the emotions during that time?
Um, so I do think that, well, certainly nobody likes to feel like they're failing, and we certainly, wrestled with that. And, we having just completed a raise that was bigger on the adjacent parcel, we definitely cause ourselves to second guess ourselves. The thing about raising money that I always tell people is sometimes the project's perfect, the situation's perfect, and you've just reached the limit of your network, if that makes any sense.
Hmm.
Meaning that, I could find a perfect deal tomorrow, and if I needed to raise $100 million, I might not be capable of that, right? I may not
Right.
have the network to do that, or the time, or the timing could be off. And so, what we really had to do was just think like, do we really think that we were incapable of raising this amount of money, or was it really just the timing? So there is a lot of self-reflection involved in this, because unless you identify the real reason why you failed or why you didn't complete your goal in this case, or complete it on the proper deadline, if you don't know the real reason, then you can't really solve the problem, right?
Yeah.
So we didn't know for sure if the market was telling us, hey, we're not interested in the project, or hey, we're not interested in the project right now today because of what's going on in the world. We're not interested in you. Everything's great, but you don't know enough people with enough money to invest. So these are all the questions we had to go through. I wouldn't say that we cried. We definitely probably consumed more glasses of alcohol as a result of this experience. And when you have the dual threat of the public health crisis and the pandemic, and then also you feel like your business is struggling too, or especially compared to your own expectations, it definitely can wear on you for sure. So, but
Hmm.
we thought this was a great lesson and a great story to tell, because it isn't perfect, right? And it isn't, we didn't do it exactly. A lot of times we hear all these stories like, oh yeah, I put a deal out and I raised the money in 20 minutes. And you're like, oh, cool story. But you don't really learn a lot from
Yeah. Yeah.
that. For us, this was really all about being patient, making the investors first. And look, everyone says that. Everyone says, oh, the
Right.
investors are first. But I mean, if the investors are first, then sometimes that means you don't slam somebody into a deal that's not appropriate. And, for some investors, their risk calculus was, hey, we're not sure what's going to happen with the virus. We're not sure what's going to happen with these things. And we want to get more clarification on these things before we invest. And, if we're trying to strong arm somebody into a deal, then we're not really putting them first. And so for us, the patient strategy, was ultimately the correct strategy. I mean, I think we knew that at the time. I think we always knew
Hmm.
we were going to complete the raise. I don't know if I was surprised or shocked on the timeline. Also, too, I don't think as much as we were researched and knowledgeable about COVID, kind of an early stage, I don't think that any of us thought the United States' response to and the success and failure of the United States in terms of COVID would be as bad as it has been, in terms of just where we stand in the world and on that matter. So, look, we were surprised too. So yeah, not a lot of tears, man tears, crying into our whiskey probably would be our version of that. And then, just really taking a step back and trying to diagnose what was the real reason why the raise wasn't as successful as we wanted. And when we determined it was ultimately probably more due to timing and fear of the unknown than the project itself.
Yeah, that's a great reflection to have during those times.
Sure.
How is the project doing right now?
It's going well. It's a little behind, but not not especially so. Obviously the couple things we ran into is, with COVID, there were some municipalities that closed, right? So, like for example, there's a city meeting that has to happen to approve your project, and those got canceled. Some state and local constitutions enshrine the idea the public has a chance to speak, and so if meetings are canceled, so we had some delays from that. There's obviously been some supply chain disruptions, right? So things that you order and you get them in 6 weeks, now it's taking 30 weeks, and price changes and things like lumber, that kind of stuff. So we definitely have battled through a lot of stuff, but ultimately the project is very close to being on track. If we're not going to make up for lost time and get it back on schedule. And then we just have an abundance of lessons along the way and things to think about. And the average investor didn't really think about supply chains much a couple of years ago,
Yeah.
and now all of a sudden everyone's like, so sensitive to those ideas and those concepts, and just how to develop in a pandemic has been a crash course, in learning on that front.
Pretty awesome. Um, I know you already talked about, how you guys reflected on if it was just you guys or the actual situation, but are there any other tips that you can give our listeners on how to deal with unplanned situations like this one?
Absolutely. I mean, I think the first thing is, um, if you were to think about all the things it takes to write a business plan, I think the first thing you have to be is you have to be realistic. And so when you're realistic and you're writing a business plan, one of the questions you should ask yourself is, how could this go wrong? What are the problems this deal could have? And then try to be creative and then kind of pre-plan. Um, so much about people that write business plans, it's all optimism. So for example, if we would have just assumed, oh, we're going to raise this money, no problem, we hadn't set the floor, then we potentially could have had to rewrite the operating agreement. That could have caused other investors to be spooked. And so instead we just said, hey, this is the minimum amount we're going to raise. This is the maximum amount we're going to raise. So that's kind of an example of that. So just always go through your business plan and just think through things that could happen. Maybe you won't raise all the money. Maybe you'll have some price increases. So you need to have a healthy contingency, things like that. So a lot of what made us successful on this project or come to a successful conclusion really dealt with, going in, being realistic, and then also asking, where can we have problems? And if we do have these problems, what's our plan in case we face those? Because having that in your back pocket when something does happen and you've already kind of planned for it, it helps a lot in the moment because you don't feel like you're being blindsided by something you couldn't see coming.
Got it. Wow, Lo, this has been such a wealth of information. I really appreciate you being so honest and straightforward and sharing all of these lessons. I'm sure there are so many more that you guys went through just for this project alone. How can our listeners get in touch with you?
Yeah, certainly. The best place to go really is our website. So our capital raising company is Good Horn Capital. So goodhorncapital.com. They can, schedule a time to have a conversation with us if they want to learn more. While this project wasn't about, was about build to rent, I've also written a book about residential assisted living, which is kind of our secondary asset class that we focus on. They can download a copy of the book and we'll give them a free version of it so they can learn a little bit about how we think about operations. So again, just goodhorncapital.com. And if they want to shoot me an email, it's just loe@goodhorncapital.com. So happy to help any way that I can.
And as always, all of these links will be under show notes. Lo, thank you so much for joining us. I really, really appreciate your time.
Great. Thanks for having me, Steph.
If you haven't already, make sure to subscribe to our very straightforward newsletter at montecarlorei.com on top of the page. And I would love to thank one of our latest reviewers, Ivan Nemorin. Thank you. Podcast episodes are concise with step-by-step examples. Truly great content. Thank you much. You are most welcome, Ivan. Thank you for your review, and I will see you guys next time.